How the rich avoid paying tax. In our quest for a financially secure future, saving money is a top priority. It forms the bedrock of any sound financial plan, enabling us to cover expenses even during periods without a steady income. Yet, the burden of income tax on our taxable income can chip away at our savings, leaving us with less to invest in our future. Warren Buffett, with a net worth of over $100 billion, pays only 17.4% of his taxable income, less than what his secretary pays. In this video, we'll dive into 7 top tactics that the super rich use to avoid paying taxes. But before we continue, click the subscribe button below and turn on your notification bell so you don't miss out on any of our videos. Without further ado, let's dive in. Seven, reinvesting gains. When it comes to taxes, the amount you owe is determined by your taxable income and the tax rate that applies to that income. Taxable income is the amount of income you earn that is subject to taxation, after accounting for any deductions and credits that you may be eligible for. In general, trading activities can generate both capital gains and losses, and these are subject to different tax rates than ordinary income. Capital gains are typically taxed at a lower rate than ordinary income, which means that if you can classify your trading income as capital gains, you may be able to reduce the amount of income tax you owe. To accomplish this, you would need to structure your trading activities in such a way that they qualify as capital gains instead of ordinary income. One way that rich do this is to hold their investments for a longer period, which can allow them to qualify for long-term capital gains rates. Another option they go for is to invest in assets that are more likely to generate capital gains, such as stocks or real estate. 6. Moving to a place with little or no tax requirement. One way that the rich reduce their income tax is by moving to a place with little or no tax payment. Several factors determine how much tax someone owes, including their income level, assets, and the tax laws in their place of residence. By moving to a place with lower taxes, such as a state or country with a low income tax rate or no income tax at all, individuals can potentially reduce the amount of taxes they owe. For example, some popular destinations for those seeking to lower their tax bills include Monaco, the Cayman Islands, and Dubai. The potential savings from moving to a place with lower taxes can be significant. For high earners, the difference in tax rates between two locations can be tens of thousands or even millions of dollars per year. Additionally, some places with low taxes may also offer other benefits, such as a more relaxed lifestyle or favorable business conditions. Moving to a place with little or no tax payment is a strategy that many wealthy individuals use to reduce their income tax. 5. Real estate investment. Depreciation deductions allow investors to deduct a portion of the cost of the property each year, based on the property's estimated useful life. This deduction can help reduce the investor's taxable income, which in turn lowers their tax liability. Another tax-saving strategy for real estate investors is the 1031 exchange, which allows them to defer capital gain taxes when they sell a property and reinvest the proceeds into a new property. Essentially, a 1031 exchange allows the investor to roll over the gain from the sale of one property into the purchase of another property, without paying taxes on the gain at the time of the sale. Real estate investments can offer a range of tax benefits for wealthy individuals, making them a popular way to reduce tax liability and increase wealth. 4. Trust and estate planning. Some wealthy individuals use trust and estate planning to minimize their tax liability by transferring assets to future generations. In simple terms, a trust is a legal arrangement where a trustee holds and manages assets for the benefit of one or more beneficiaries. Estate planning involves making decisions about the management and distribution of a person's assets after they die. By transferring assets to future generations, they can potentially reduce or eliminate the amount of estate and gift taxes that would otherwise be owed. Estate and gift taxes are taxes levied by the government on the transfer of property or money from one individual to another. One benefit of trusts and estate planning is that they can help to protect assets from creditors and lawsuits. By placing assets in a trust, individuals can ensure that they are not subject to seizure by creditors or judgments in legal proceedings. 3. Charitable donations. Have you wondered why a lot of rich people own charitable organizations? This is the reason. Some wealthy individuals establish charitable foundations and donate to them. They can then deduct the amount of their donation from their income tax, which can help to reduce their overall tax burden. However, they still control the foundation and can use the money for personal expenses, effectively avoiding paying taxes on those funds. Sometimes, wealthy individuals can also donate to private charities that they have a personal connection with, such as those affiliated with their alma mater or cultural institutions. While these donations are typically tax-deductible, wealthy individuals can often exert significant influence over how the money is used, potentially benefiting themselves or their businesses. 2. Buying art. In many countries, art can be considered collectible and is subject to special tax treatment. For example, in the United States, art can be classified as a capital asset, which means that when it is sold, any profit is subject to capital gains tax rather than income tax. Additionally, some countries offer tax incentives for individuals who donate art to museums or other cultural institutions. In the United States, individuals who donate art to qualified organizations can generally deduct the fair market value of the artwork from their taxable income. This can be a particularly attractive strategy for individuals who have a large taxable income and wish to reduce their tax liability while also supporting cultural institutions. However, it is important to note that investing in art is not a guaranteed way to reduce one's tax liability. The art market can be unpredictable, and there is no guarantee that a particular artwork will appreciate. Additionally, the rules and regulations governing the taxation of art can be complex and may vary by jurisdiction. 1. Investing in a privacy coin. Privacy coins are digital currencies designed to offer users enhanced privacy and anonymity in their transactions. Unlike traditional cryptocurrencies like Bitcoin, which have transparent blockchains that allow anyone to view transaction histories, private coins use advanced cryptography to obscure transaction details, making it difficult for anyone to trace the source and destination of funds. While investing in private coins may provide enhanced privacy, it is important to note that tax laws apply to all types of investments, including cryptocurrencies. The tax treatment of private coins is similar to that of other cryptocurrencies, which means that if you sell your private coins for a profit, you will be subject to capital gains taxes. However, there may be situations where investing in private coins could potentially reduce the amount of tax rich people pay. For example, if a wealthy individual has a significant amount of taxable income and wants to reduce their tax liability, they may choose to invest in private coins in a tax-efficient manner. One possible strategy is to hold the private coins for more than a year before selling them, which could qualify the investors for long-term capital gains tax rates that are typically lower than short-term rates. Additionally, if the investor can realize losses on other investments during the same tax year, they may be able to offset some or all of the capital gains from the sale of the private coins, thereby reducing their overall tax liability. It's important to note that while some wealthy individuals may use these strategies to minimize their tax payments, it doesn't necessarily mean that these methods are advisable for everyone. Attempting to use some of these tactics without proper knowledge or guidance can lead to legal and financial consequences. That being said, it's worth educating yourself on the different ways you can legally and ethically reduce your tax burden. Working with a qualified financial advisor or tax professional can help you determine which strategies are best suited for your situation. In the meantime, we hope that this video has provided you with some insights into the tax-saving techniques employed by the rich. Let us know in the comments which strategy you found most interesting or which one you might consider implementing in your financial planning. Don't forget to subscribe to PLUTUS and hit the notification bell to stay up to date with our latest videos. Thanks for watching.